Hi guys, it's Stock Harry, and even though the stock market started out extremely bearish, it turned around and rallied towards the end of the day, and this move was not as irrational as you might think. There was a good reason behind it. I'm going to tell you why and where the market goes from here, so let's get into it. In yesterday's video, I went over the technicals and showed you why today was going to be a critical day. I explained how we were right at the 200-day moving average on the S&P, and that today would determine whether we continued going lower and essentially got a market crash, or if we turned around and rebounded off of the 200-day EMA and continued to go higher. And today we got our answer. We clearly rebounded and rallied significantly, and the signs at least look like Friday could go higher. Now, it's still not a complete certainty because sometimes technical analysis rejects. It's not 100%. And when we started the day out, we actually started the day extremely bearish. We ended up opening below the 200-day moving average. We actually fell below it throughout the day, and it looked like we were on track to just have a massive crash over the next week or two. And then we ended up getting some news that flipped things around. But first, I want to go over the news that started the morning out so extremely bearish. The 2-year Treasury yield reached the highest level since 2007. That's right, 2007, right before the financial crisis. The 10-year Treasury yield skyrocketed well above 4%. And as I told you yesterday, once the 10-year Treasury gets above 4%, a lot of money starts getting pulled out of the stock market and gets put into the bond market. And we saw a lot of selling in the stock market this morning because of that. In addition, mortgage rates jumped back over 7%, rising to 7.1% on Thursday. This is the highest rate in 20 years. And as interest rates and mortgages continue to rise, this makes homes completely unaffordable. In fact, we remain at the most unaffordable level in history in the housing market. And this is one of the reasons that we've seen home prices decline for the past 5 months in a row. And it looks like home prices are going to have to continue to decline in order to fix this unaffordability situation that we're currently in. Fact is, people simply can't afford to buy a lot of houses, and that's why we're seeing a lot of sales decline. Now, that was all of the news that pushed the markets down in the morning, and for all intents and purposes, all of the fundamentals are excessively bearish, and the market should have continued down and crashed. Yet, if you take a look at where the markets closed, they closed up about 1%. So what happened? What flipped the markets today? News articles came out saying that the Atlanta Fed's Bostic favors hiking their policy rate by 25 basis points in March instead of 50 basis points. One of the reasons the stock market had been selling off was over fears of a possible 50 basis point rate hike at the March meeting. And when one Fed member came out and said that he supported a 25 basis point rate hike, the stock market absolutely rallied. In fact, the NASDAQ had a 2% intraday move from lows to highs after this news came out. It was a massive rally in the stock market. Yet, when I went in and read exactly what Bostic said, it was not nearly as bearish as the news articles made it seem. Bostic said one data point that I am looking at in particular is month-to-month change in inflation. To the extent that we start to see that trend down, then I will be comfortable with a 25 basis point move. But if that continues to persist at elevated levels or even moves in the other direction, then I'm really going to have to look at a 50 basis point move for March. Well, this is exactly what Fed members have been saying all along. This isn't new news. This is exactly the same. But just like during this ultra bullish, extreme greed period that we were in December and January, the market completely ignores all of the negatives and they just focus on the little sliver of positive. if there's a speech that's 90% negative and 10% positive, the market will just focus on that 10% that's positive and it'll rally. And that's what happened again today. So it looks like greed still remains very strong in the stock market, which would tend to indicate that we're more likely to continue higher than go down. However, don't forget exactly what Bostic said. He said, if inflation continues to go down, then he would support a 25 basis point rate hike. But if it stays flat or even starts to go back up, then he would look at a 50 basis point rate hike. Now remember that the Fed's preferred measure of inflation is PCE, the Personal Consumption Expenditures Index. And PCE in January increased from 5.3% in December to 5.4% in January, and core PCE increased from 4.6% in December to 4.7% in January. So inflation did increase, which would seem to support Bostic going after a 50 basis point rate hike in March instead of a 25. And in fact, if we look at the CME futures and where the market expects the Fed to raise interest rates by, yesterday there was a 29.9% chance of a 50 basis point rate hike. And today there's a 29.2% chance of a 50 basis point rate hike. So the comments really didn't change the bond market much. We didn't see a massive buying of bonds or any switch over anything. In fact, everything stayed pretty flat in the bond market. It was only the stock market that rallied. The fact of the matter is, after a year of Fed rate hikes, they still have a long way to go in the fight against inflation. Inflation is still well above the Fed's target of 2%. And there's growing concern in the financial markets that more interest rate hikes will be needed, even more than the central bank officials anticipate. Another big market fear is that the Fed will cause a recession with its rate hikes. Thus far, though, a recession looks, at the very least, not a threat in the near term. The jobs market has been stunningly resilient, posting an unemployment rate of 3.4% that is tied for the lowest level since 1953. There are, though, trouble spots. While housing is mirrored in a prolonged slump, manufacturing has been in contraction for the past 3 months. Consumers, though, remain strong, with retail sales popping 3% in January as shoppers spent their savings and spent money on credit cards. U.S. consumers have been on a shopping spree ever since the COVID reopening back in 2020. While that's good news for those wanting to see the economy buoyant, it's not necessarily pleasant for a Fed who is purposely trying to slow down the economy so that it can bring inflation under control. Now, one confounding part of the Fed's efforts is that policy moves are supposed to work through financial conditions, which is this algorithm of indicators covering everything from bond yield spreads to the stock market to mortgage rates and a bunch of other measures. The Chicago Fed has a tracker that provides a good gauge on which direction things are heading as far as financial conditions are concerned. And what's really interesting is that even though the Fed has continued to tighten policy and raise interest rates and sell off their balance sheet, the Chicago Fed Index of Financial Conditions actually shows that financial conditions have eased since October. And what's particularly confounding is that Powell says that financial conditions have tightened very significantly ever since the rate hikes began. Yet the Fed's own National Financial Conditions Index shows that is not the case, and that financial conditions are actually looser than they were when the Fed first started raising interest rates. Nobody's really sure why Jerome Powell continues a blatant lie, but one thing is for sure, the Minneapolis Fed president says that there's more work ahead. He said, I am conscious of, hey, if we declare victory too soon, there's going to be this flood of exuberance, and then we're going to have to do even more work to bring that back down. So we're going to continue doing what we're doing until we finish the job, and I'm committed to doing that. So don't be fooled by today's rally. Yes, it was extremely bullish. The S&P 500 had what's called a bullish engulfing candle, which is an extremely bullish indicator, which indicates a reversal in a down market. And on top of that, it bounced right off of the 200-day moving average. Both of those are great indicators showing that the stock market will probably turn around and continue to rise, at least technically. Don't forget that technical analysis is not 100%. In fact, it only works about 60% of the time. So we have about a 60% chance of going up and about a 40% chance of going down based upon the technicals. Now, the fundamentals remain extremely bearish. With the fact that the 10-year treasury is above 4%, mortgage rates are above 7%, all signs indicate that the Fed is going to continue to raise interest rates, and they absolutely are not going to lower interest rates by the end of the year. The fact that inflation is actually turning around, starting to go back up. The fact that the job market remains strong and the Fed's going to have to fight that in order to get inflation down. The fact that consumers continue to spend and the Fed's going to have to fight that in order to get inflation back down. All of that is extremely bearish. So even though the technicals point to a rebound, don't continue to all out believe that the market's going to go up just because the technicals had one bullish day. The fundamentals remain extremely bearish. And even though timing when the market's going to go down is impossible, the fact is the market will eventually get in line with the fundamentals and it will drop. We just don't know when. Now let's move on to some individual stock market news. Tesla shares were down over 5% after their investor day. And this is pretty common for Tesla. Whenever they do a major event, Tesla shares typically drop anywhere from 3% to 10% the day after the event. In fact, you almost could have bought put options yesterday and had a 90% chance of making money on them. Ford also announced that they plan to restart production of their electric F-150 Lightning on March 13th. That's going to be bullish for Ford and bearish for Tesla. Ford stock was up about 1.8% today on that news. Macy's shares also jumped after their holiday quarter profit topped expectations. They did warn that they are planning for a choppy year ahead, though. Regardless, Macy's was up over 11% on the day. And Best Buy also topped holiday quarter expectations. And just like Macy's, Walmart, Target, and pretty much every other retailer, they warned of further sales declines in this coming year. People seem to focus more on the forward guidance rather than the earnings beat, and Best Buy was down about 2% on the day. And just like Best Buy, Macy's, and pretty much every retailer, Nordstrom also topped their earnings expectations for last quarter. But the stock barely moved. It was up less than 1% after hours. So that's everything that happened today. Where do we go from here? Well, like I said, we have about a 60% chance of going up and about a 40% chance of going down. I think tomorrow is going to be a very critical day. If Friday actually rises, then we actually get continuation and confirmation of the technical turnaround. And that would be a pretty strong indicator that the market's going to rise next week. But if the market falls on Friday, that would be an indication that the technicals were failing and that we are not going to rise and that the fundamentals will remain in place and that the market will continue to fall over the next week or two. So very, very uncertain, but we'll definitely get a lot more clarity on Friday. Now, I'm also going to be buying some stocks on Friday and taking advantage of this little pullback that we've had. If you want to know what stocks I'm going to buy, make sure you hit the like button, subscribe, and if you're on YouTube, click that bell icon and click all so that you can get notified when I release my video. If you got a lot out of this video, please be a good friend and share this video with your friends and family. And I hope you guys have a lot of success trading. If you missed the video that I went over yesterday where I explained all of the technical analysis and all of the reasons why the market would go up and why it might go down, make sure you watch the last video that I uploaded here.